In this example, we will be using present value to value bonds. We have Kirby Inc. is considering the sale of two bond issues. We have Choice A and Choice B. Choice A is a $100,000 bond issue that pays semi-interest of $64,000 and is due in 20 years. Choice B is an $800,000 bond issue that pays semi-annual interest of $60,000 and is due in 15 years. So assume that the market interest rate for each bond is 8%. So we will calculate the amount that Kirby will receive if both bond issues are made. So what you have to do on these is you have to use the present value tables in the back of your book. And you're going to use both of the tables because what we have to do is calculate the present value of the lump sum, the bond issue, and then the present value of the series of the interest payments. And then we have to take into consideration that Choice A is 20 years, but they pay semi-annually, so there'll actually be 40 payments, not 20. And then since the interest rate is 8%, that's for a year, so each period will be 4%. So when you use the back of the book for Choice A, you're going to use 40 periods, because that's how many times they pay interest, twice for 20 years. And then the interest rate is 4% for every period. Okay? And then when we do Choice B, it'll be similar, only we're going to have 15 years. And it also pays semi-annual, so we'll have to use 30 periods and 4%. So first let's take a look at Choice A. So the present value of 40 periodic payments at 4% from Table 2 gives us a factor of 19.793. And that's the interest. So we take the $64,000, which is the amount of semi-annual interest. So that gives us a present value of $1,266,752. Then we have to take into consideration the lump sum payment. So there also is going to be a lump sum payment at the end of the 20 years of the $800,000 bond issue. So we find Table 1 for lump sums, and we find our 40 payments, and we match it up with our 4%, and we get a factor of 0.208. So the present value of the $800,000 bond issue lump sum is $166,400, and then the present value of all of the interest payments is $1,266,752. So the total present value of Choice A would be those two added together, $1,433,152. So keep in mind that the way a bond issue works is the face amount is paid back at the end. It's a sense of borrowing the money, and then interest payments also have to be made, which is why we have to calculate both. Then we look at Choice B, and Choice B is going to be the 30 periodic payments, because 15 years pays twice a year, that's 30 payments, and then 4%, half of the 8%, because basically they're paying 4% in the first half of the year, and then the other 4% in the second half of the year. So we take our interest of $60,000 times our factor of 17.292 that we got from the table using the 30 periodic payments and the 4%. And again, that's Table 2 because it's a series of payments. And then we take our $800,000 bond issue times the factor of 0.308, which that factor comes from Table 1, a one-time lump sum payment using 30 periods and 4%. So when we add those together, we get $1,283,920. So the total issue price for both of them together, this is our present value, is $2,717,072.